If there's a failure to deliver, it might be at $55 or something, and you wake up the next morning and suddenly it's above $100 or $80, and you didn't have a chance to buy between those times. We could be seeing the last of double-digit silver this month. I do think that somewhere 5,000 is an absolute minimum for gold, but I think that's even silly. I think we're going to be seeing $10,000 gold. The explosion that we are going to see in precious metals, $10,000 gold is almost like a silly low price. I said 5,000 earlier, but that's 5,000 is absurd. That's not even on the table. $10,000 gold minimum is like a destiny.
What if the last affordable ounce of silver is already gone and none of us realize it yet? Mike Maloney, bestselling author, has been warning for years about the coming reset in precious metals. Now, he believes we're entering the most critical phase yet. He cautions that if a failure to deliver event strikes the silver market, it could happen fast, likely around the $55 range. One night you could go to sleep with silver comfortably under $60, and by morning it could leap straight to $80 or even $100 with no chance to buy in between. In his view, these may very well be the final days of double-digit silver, and that transition could unfold within weeks. Maloney argues that everything changes once silver breaks decisively above $50. Historically, silver has always lagged gold during major bull runs, and that was true even in 1980 when the metal spiked into what he calls a super spike, a full-blown hyperbubble compared to the rest of the economy. In that episode, gold was the leader, and silver was merely being dragged along. This time, he believes the dynamic could flip once silver clears $50. Then $55 and $60, the world will finally start paying attention to the metal's underlying fundamentals, from supply constraints to monetary debasement. While he acknowledges that a brief cooling-off period near $50 would be technically healthy, Maloney also knows markets don't always behave rationally. As Maloney puts it, when gold surges sharply, the emotional energy is identical to a stock market crash, only inverted. So, while silver might pause, it might just as easily detonate and run straight through resistance into territory no one is prepared for. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
And you know what? Bill, I believe, is right. Once silver passes this $50 threshold, and we're just, that's what my previous videos were about. We're just about there. It gets into the news cycle. The mainstream media will be reporting on this, and as it goes north, they are going to be reporting on it at first, a few, and then it's going to be every week, and then every day they're going to be hearing about silver, the general public. Now, it also goes along with October is the spooky month, this month that is famous for crashes. And there's going to be a video upcoming that's all about the economy and showing you where we are right now. And we really are teetering on that knife's edge. Bill is probably right. As it goes past 50, 55, 60, and people learn about all of the fundamentals underlying silver, about the fundamentals underlying, the video that we did showing that there was $20 trillion worth of liquid capital that can come chasing any investment in like 24 hours. That was just America. When you take it to the world, I covered that in one of my videos that I just recorded. It's actually 3.5. If you take 1% of the 20 trillion, that's 200 billion that could come chasing silver. There isn't enough silver at these prices to support anything near that. And 1% is a nice conservative figure. But when you add in global currency supply and global stocks and global bond market, now you're at 3.5 trillion that could come. It's 350 trillion is the total of those things. You're at 3.5 trillion that could come chasing the precious metals. And that's only 1% of these things. The liquid capital, the stock market, and the bond markets globally because when we talk about how much gold and silver there is, that's globally. That's what we're talking about. So you've got to compare oranges to oranges. Well, that was a super spike. And compared to the rest of the economy, that was a hyper bubble, which gold and silver are destined for far greater hyper bubbles this time, because this was only Western Europe and North America driving this. Australia was included as well, but it was 10% of the world's population. This time it's going to be everybody. There was, I think, I can't remember the amount of, we're up to 80 times more currency now that you've updated it. When we released the book, it was 55 times more currency on the planet. And all of this, and then the size of the bond markets, and then the trouble that the economy is in, the levels of debt to GDP. In 1980, it was down at 30%, not 120%. The economy, the US dollar, everything is in a vastly different position than it was during those 6 days and the added 2 days. So there was only 8 days when silver was above 40. And like I said, gold and silver both went into super spike hyper bubbles compared to the rest of the economy. And so if you put a super spike today with the growth of everything else we've had, you and I come up with these astronomical figures that sound irrational, yet if you do the analysis, it's the only rational outcome. This was when gold was peaking, and that's what was pulling silver up. This time period was gold's big run, sometime in August, probably. Where silver peaked on this chart, right under that number 5. It would actually be good for silver to sort of take a rest, and I always expected it to as it runs into the $50 area. If it goes sideways for a couple of weeks, it works off the overbought condition that it's in and allows a lot more room to run. However, in a currency crisis, in a market crisis, all of that stuff, overbought conditions, it all goes out the window. None of that technical analysis matters when you have a true panic with the precious metals. The precious metals are a very special asset class that sort of obeys its own rules. And we showed that in our book, The Great Gold and Silver Rush of the 20th Century, when you get to the area, the section on Giffen goods, and the gift of Giffen was the section. And in there, we showed that something I noticed many, many years ago. If you take a chart of gold and flip it upside down, it looks like the stock market. It's got rounded tops when you flip it upside down and very sharp, spiky bottoms, just like a market crash. So when gold is going up and makes these spiky tops, it's the same emotions as a market crash for the rest of the economy. One last thing. This could continue right to the end of the year. This could just keep on going north, or it could take a little pause, like I said. It could do a little bit of a pullback. We could be seeing the last of double-digit silver this month. It could happen all this month.
Mike Maloney highlights one of the most misunderstood dynamics in precious metals: the staggering disconnect between silver's supply ratio and its price ratio relative to gold. Currently, the world mines roughly 7 ounces of silver for every 1 ounce of gold, yet the market prices them as if gold is worth 81 times more. Maloney believes that gap is wildly unsustainable. His strategy? Accumulate silver now, then convert it to gold when the ratio collapses below 20-1, a level he sees as inevitable. At that point, with $10,000 gold, silver would be trading around $500 an ounce, and if the ratio briefly spikes to 10-1, silver holders could walk away with 8 times more gold than they initially paid for. And that, he argues, is why silver is the ultimate leverage play. Maloney predicts the coming precious metals cycle won't just be another bull market, it'll be a historic monetary event. He now considers $10,000 gold the minimum outcome, calling his earlier $5,000 target absurdly low in hindsight. Once gold begins its explosive move, governments may try to halt the chaos by pegging a new global currency to gold, temporarily freezing its rise. But silver won't be constrained, it will overshoot dramatically in a violent, super spike. then cool off. Let's get back to the interview.
First Majestic says, while silver has had a good rally, let's not forget the basics. The silver to gold mine supply ratio is that there is 7 times more silver being mined than there is gold. There's 7 ounces of silver coming out of the ground right now for each ounce of gold that comes out of the ground, while the gold-silver ratio is trading at 85 to 1. So silver's price is 1/85th of an ounce of gold, or it takes 85 ounces of silver to equal the value of an ounce of gold, when we're digging up only 7 ounces of silver for each ounce of gold, and then the gold, 95% of it, just goes into vaults or is above ground in bars or jewelry or something. It doesn't get disposed of, where the silver, 2/3 of the silver, of those 7 ounces of silver, 2/3 of it gets used up in industry and thrown away. So it's actually a lot more skewed than he's saying. We're still very early. Now, this is the proper way to price silver. How many ounces of gold is it worth? If you do this, you will find out that silver is an absolute screaming bargain, even at $46. It is severely, severely undervalued. Now, Happy Hawaiian says, now that's a gold-silver ratio breakdown. He's got a 3-month chart here of the gold-silver ratio. Remember, the last comment said it was at 83 or 85. It's actually at about 81 while I'm making this video. But here's the last 3 months. I don't know what he's pointing out with this megaphone pattern here, because it doesn't really line up with these candles that well. But this is the breakdown that he's talking about. Now, let's get some perspective on this. This is 3 months. So let's take the long view and really find out what we're doing. So here is a 3-month chart on my website, goldsilver.com. And this is the breakdown that he's talking about. And it ended up at 81.53. And so that's the breakdown, 3 months of ratio action. But that time frame is 3 months. Let's go to all data here, which takes us back to 1994 or January 1995. And what you see here is that the average is really like below, it's 60 or below. And we're coming off this peak of 100. It was 120 during COVID. This is monthly data. So it's the average for the month. It's not or maybe it's the close of the month, but it's not daily data. If you could see this went over 120, if it was daily data, and this went down to 30. And so if somebody buys silver today at 81, and it drops to a ratio of 20, it was 14 in 1980 when gold and silver peaked. And if it goes down to 20, which I am expecting it to blow right through. I do expect 20, and I am going to be doing this at 20, where you convert some of your silver to gold. But I'm expecting this time. So see, back in 1980, there were huge government stockpiles. We didn't have shortages on the commodities exchange, and well, there was on the commodities exchange, but everywhere else in the world, there were stockpiles of gold and silver. There wasn't a structural deficit where we're using up more silver and throwing it away year after year after year than we are mining, shrinking the stockpiles to critically low levels. There wasn't the levels of deficit spending. There wasn't a currency crisis coming, and I believe there is. And so there wasn't these crisis levels that are going to drive the silver price as people rush into silver more and more and more, and as the media starts covering it more and more and more, when it starts setting these all-time highs, and as more of the mainstream analysts and companies, like you saw TD Securities and you saw Morgan Stanley, they're talking about this now, where they weren't before. As all of this starts to happen and people start to pile into silver, this is going to go down. I do think that somewhere 5,000 is an absolute minimum for gold, but I think that's even silly. I think we're going to be seeing $10,000 gold. Well, at a 20-to-1 ratio, that's $500 silver. and nobody thought that a gold-silver ratio of 14 was achievable. But when the bull market in the 80s, the 70s started, the gold-silver ratio was averaging at around 30, not up at 80 where it's an extreme bargain. Now, if you buy at 80 and you convert to gold at 40, you're getting twice as much gold as you paid for. If it goes to 20 and you convert, that's 4 times more gold than you paid for. And if it does go to 10 and you convert, you're getting 8 times more gold than you paid for. Why would anybody buy gold right now? I mean, I let this dictate to me what I buy, and this is how I ended up with 300 ounces of silver for every ounce of gold that I owned. When it went down here below 50, I wasn't buying any silver. I bought only gold there. But I used to make monthly purchases, and every time it was above 70 or 80, I was buying only silver. And that's why I ended up with so much silver. The explosion that we are going to see in precious metals, $10,000 gold is almost like a silly low price. I said $5,000 earlier, but that's $5,000 is absurd. That's not even on the table. $10,000 gold minimum is like a destiny. Now, gold can go up, and then to save currencies around the planet, they can come up with a new world monetary system based on gold and peg it, and it'll stop. Silver will go into a super spike and then probably come back, but silver is still going to give you this giant leverage. So let's say 1% of each of these, that's 3.5 trillion, let alone this new mix of 20% bonds, 20% precious metals, and 60% stocks, which would mean liquidating half of the bonds. This is an absolute flood.
The case for precious metals, particularly silver, is no longer just about hedging against inflation or economic uncertainty. It's about positioning ahead of what could be a generational revaluation of money itself. With gold destined for dramatically higher territory and silver poised to move with far greater torque, the current price levels may soon look like a once-in-a-lifetime entry point. Whether the coming surge unfolds in an orderly climb or an explosive overnight reset, the message is clear. The window for accumulating real assets at double-digit prices may be closing far sooner than most expect. Will silver finally outperform gold in the next major metals rally? If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue bringing you sharp insights and expert perspectives on gold, silver, and the forces reshaping the financial landscape. Thanks for watching.